Now, let's talk about why this investment account, HSA, is better than the Roth IRA or 401k. The health savings account, or HSA, has quadruple tax benefits that you can't get with a 401k or Roth IRA. A Roth IRA has double tax benefits, but the HSA has quadruple tax advantages. And with the Roth IRA, you'll have to pay your federal, state, and FICA income taxes up front, and then the investment will grow tax-free and withdraw the Roth IRA earnings and interest tax-free when you turn 59 and a half. You can also withdraw the contributions at any time tax-free and penalty-free. With an HSA, the contributions you make are in pre-tax dollars, which means you don't pay federal or state income taxes, except for California and New Jersey at the time I'm recording this video. And you don't pay Social Security and Medicare taxes or FICA for the HSA contribution. And I'm going to go over some state exemptions in a little bit. And what you probably didn't know is that you can actually invest what you contribute to the HSA to index funds, ETFs, bonds, individual stocks, or target date retirement funds. The capital gains and dividends that are paid by these investments are also tax-free at the federal level. And at any time, you can take your contributions, earnings, and interest out of the HSA penalty-free and tax-free as long as you use it for qualified medical expenses, which I'll also go over later on in the live stream. So I encourage you to join my private Facebook group or become a member of my channel, because I have a public live stream and private group session every other Wednesday to talk about all kinds of financial independence investment and early retirement strategies. You can visit firesidechat.com/pricing or firesidechat.com/coaching to schedule your financial coaching session. And this is how HSA generally works. And assuming that you're eligible to get the HSA with your employer under the high deductible health plan or HDHP, your HSA contributions will be automatically deducted from your paychecks. And again, this is your pre-tax money going straight to the HSA without federal, state, or FICA taxes. And what's also awesome is that some employers can give you a match like the 401k. My employer gives me a match to the HSA every single year. Well, for now anyway. But they also have the power to stop making employer contributions. So keep that in mind. But here's the catch. Unlike the 401k, the employer match does count towards your contribution. So in 2023, the contribution limit for single individuals is $3,850. And the contribution limit for a family plan is $7,750. If your employer gives you $500 every year under the individual plan, then you're only allowed to contribute up to $3,350. With the 401k, the employer match does not count towards the personal contribution. So please keep that in mind. And when you put money in the HSA, it automatically gets deposited in the HSA checking account. You're going to get an HSA debit card in the mail when you first open the account. The second portion of your HSA will have an investment brokerage account, and you can move cash out of the checking account and put it in investments and vice versa. But keep in mind that some HSA brokers have restrictions like keeping a certain amount of cash inside a money market account before you start investing. My HSA with Optum Bank has a requirement to keep $2,000 in cash and then invest the rest. So again, make sure you read all the fine print before opening one. And lastly, you have the option to move money out of HSA and put it in your checking account at any time, but only if you use it for qualified medical expenses. You can't just use it for whatever you want, or you're going to get penalized for 20% plus federal and state income taxes on top of the penalty. And after you turn 65 years old, then you can spend your HSA on non-qualified medical expenses, but you'll just have to pay ordinary income tax, right? Here are some state exemptions. So if you live in California or New Jersey, I'm sorry, you're going to have to pay some taxes on this. But almost all the states won't tax your HSA contributions, okay? Almost. If you live in California or New Jersey, your HSA contributions and employer contributions are required to be treated as taxable income, but only in California and New Jersey. you're still not gonna get taxed by the federal government, but California and New Jersey still want their piece of your pie. And if you live in Tennessee or New Hampshire, you're required to report dividends and earnings inside your HSA. They don't tax your contributions, but New Hampshire and Tennessee require you to report your dividends and earnings if they amount to certain dollars, whether you're single or married and filing your taxes jointly. These rules and laws are subject to change. So be sure to look up your state laws about income taxes and dividends. And I live in the state of Nevada, so I don't need to worry about paying state income tax or reporting my earnings in my HSA. And let me show you the simple comparison chart between HSA and Roth IRA. The HSA allows you to make pre-tax contributions, which means it will lower your taxable income every year and potentially save hundreds, if not thousands, in federal and state income taxes every year, depending on your marginal tax rate and the state you reside. Your employer could give you an employer match to the HSA or just a straight up contribution based on the provider you have. But keep in mind that unlike the Roth IRA, you don't need to have an earned income to contribute to your HSA. You just need to be enrolled in the HDHP. And when you start investing, your HSA will grow tax-free inside your HSA and reimburse yourself at any time as long as you have the medical receipts to provide proof of medical expenses. And after age 65, you can use the HSA for anything and not owe any penalties, but you will owe income taxes on the non-medical distributions. And for the Roth IRA, the contributions have to be in after-tax dollars from your checking account. So the IRS assumes that you already pay taxes on the contributions you made because your W-2 paychecks have federal, state, and FICA taxes deducted. With the Roth IRA, you don't get an employer match or employer contribution, but the investments inside the Roth IRA will also grow tax-free just like the HSA. The difference is that I can make the withdrawal on my contributions at any time without justifying that they're for medical expenses because I already pay taxes on my Roth IRA contributions. So the government can't tax me twice, right? And when I turn 59 and a half, I can withdraw the earnings and interest that accrued inside the Roth IRA, both penalty and tax free. And I have been using this financial independence checklist or the FIRE checklist since 2017. And I actually didn't get to start contributing to my HSA until a year ago in 2022 because my previous employer didn't have the high deductible health plan or HDHP. You can also download this FIRE checklist and my other financial independence resources for absolutely free by visiting firesetcha.com/resources. And if you're wondering what equipment I have in my YouTube studio, you can visit firesetcha.com/shopping to check out my shop. But anyway, I'm prioritizing HSA over the Roth IRA because HSA allows me to save about $1,200 a year on taxes. After I max out the HSA, I max out the Roth IRA, which is on step 6 of my FIRE checklist. And after I max out both HSA and Roth IRA, I go to step 7 to max out my 401k. If you join my private membership group, I'm going to talk about what I have in my HSA in the private group coaching session immediately after this live stream. Just imagine this for a second, okay? You can treat your HSA like a combination of a traditional IRA and a Roth IRA. The primary purpose of the HSA is to pay for your medical expenses. But what people like me do is actually treat the HSA like a separate investment account. And I get to contribute to my HSA in pre-tax dollars, grow my HSA investment tax-free, and withdraw my HSA investment tax-free if they're used for medical expenses. And what's awesome about the HSA is that I can just invest all of my HSA contributions and use my cash to pay for my medical expenses. I'm very organized with the HSA because anytime I make a withdrawal from my HSA, I need to have a receipt to prove that it was a medical expense. So, for example, let's say I have a Costco pharmacy receipt in the amount of $100 from 2022 for my contact lenses. And I paid $100 out of my own pocket, and I never touched my HSA. Because I didn't use my HSA to pay for my contact lenses, and as long as I keep this receipt, I can withdraw $100 from my HSA at any time tax-free and penalty-free. And I can reimburse myself that $100 this year, next year, or 20 years from now. It doesn't matter when I do it as long as I have the receipt. So imagine spending $3,000 this year on medical expenses, and I get to reimburse myself $3,000 tax-free and penalty-free when I retire early. And stay tuned, because I'm going to go into the HSA investment strategy later on in this live stream.